ese nuevo dato de inflación que tenemos sobre la mesa en Estados Unidos y también cómo se están encaminando las bolsas en este cierre no solo mensual, sino también semestral. Y lo hacemos con Edward Moya, es Senior Market Analyst. Edward, thank you so much for having us a few minutes.
Oh, it's a pleasure. Thank you for having me.
Edward, today we've known the new data of inflation, the Fed's preferred inflation measure that has rose 4.7% in May, around multi-decade heights. It's 0.2% less than the previous month, but still around levels last seen in the 80s. How have you seen this new data of inflation?
Well, it confirms that we are starting to see there is a little bit of cooling of inflation. It's still very elevated, and I think what's more important is you're seeing much more weaker consumer data points. I think the economy is weakening a little bit faster than I think many people were anticipating, and it will be difficult to see how this economy can hold up with these pricing pressures. They might be cooling, but they're still taking a toll on the consumer.
And meanwhile, Powell maintains that the U.S. economy is strong and capable of withstanding rate hikes. Do we believe him?
Well, I think parts of the economy are still strong. If you take a look at all the labor statistics, we are starting to see some increase in jobless claims, but still, there is still a massive shortage for workers for some parts of the economy, and I think you're probably going to see. His outlook will change, and it'll probably change by the end of the summer. But for right now, the Fed is playing catch up. They were late to fight inflation. They need to get a few massive rate hikes in place because eventually this economy will go into a recession. That probably is more likely for next year. And if that happens, they need some ammunition to provide some support. So you're still looking at a market that is anticipating that the Fed is forced to deliver, several more rate hikes. But I think right now the more likelihood is that probably when it gets to the fall or early winter, the Fed will be at a much slower tightening pace, and this economy is going to be moderating, and growth will be rather sluggish.
Edward, Powell also asks that the Fed might be able to avoid a recession, although it's not 100% certain. What should we expect?
Well, he's right about that. No one has a handle on whether or not this economy will have a recession. I think the more likely scenario is that they still can deliver a soft landing. So I think his optimism is somewhat justified. But if these pricing pressures cool at this very slow pace, the Fed is going to have to move forward with this aggressive tightening stance, and that will ultimately send the economy into recession. This morning we saw the 10-year yield for U.S. Treasuries tentatively fall below 3%. That is really suggesting that the market is expecting a much weaker economic outlook down the road. And I think you're probably going to see that if we do have a recession, hopefully it'll be a short one and it won't be that severe because there are still large parts of the economy that are performing well. We will have tremendous fiscal stimulus that was announced before. The infrastructure, the rebuilding of America is still going to take many years and will provide some underlying support for the economy. But I think overall, right now, this country is probably looking at it's headed towards a recession at some point at the end of next year. But the inflation outlook can change dramatically. And right now, until we have a better handle on that, which we probably won't get answers for the next few months, this market's going to be very jittery.
And today is the last day of June, the last day of the first half of 22. Stocks are falling with the S&P on track to lose out worst first half in decades. What summary, Edward, can we make of this first half of the year?
It's been a terrible half, and I think right now you're seeing there has been a market that is now seeing all the major central banks, most of the major central banks are tightening aggressively, or they're about to start that, and you're going to have inflation is enemy number one, and that is posing a much more troubling adversary for these central bankers, and you're going to see more aggressive rate hikes, going into year end, and that's really killed risk appetite. I think that everyone got wrong on when inflation would peak, and now you're seeing a major de-risking moment. There's a lot of lost confidence in the stock market, and right now I think investors are now more cautiously looking for a very choppy period for U.S. equities, and you're probably going to see that whatever rallies we're seeing are being faded. So the first half of the year is really been gloomy, and I think that it's hard to be optimistic for I think the third and fourth quarter, but I think we will see a rebound in economic activity when we get those second quarter GDP numbers, and but I think we're going to probably see sub 2% growth this year, and that's what no one was anticipating at the beginning of the year.
And Edward, one last question: could we be optimistic for the second half of the year?
I think there's still a potential that U.S. assets will perform fairly well. There's been a lot of positioning that, and I think with end of quarter rebalancing of portfolios, we might have seen some excessive selling. But I think the overall take is that the long-term investor is not budging. They're staying with. They might be reshuffling a little bit of their portfolio, but they're really staying overweight on equities. And you're probably going to see that as inflation continues to ease lower. I think that's going to provide a green light for a lot of investors. And right now, I think there is still optimism. We've seen a lot of commodity prices come down, and there's expectations that demand destruction will probably further weigh on that part of the market. And I think there's good reason to remain invested in U.S. stocks, but I think we could still be vulnerable to one last kind of sell off, maybe another 5% lower, just on and I think the market kind of accepting that the Fed may have to raise rates by 75 basis points in July, and also that 75 still might be on the table in September. But I think beyond that, then we're looking at a slower pace of tightening, and that's typically what will incentivize more investors.
Edward Moya, thank you so much. It's been a pleasure.
Thank you.
Nosotros, mientras tanto, aprovechamos este